Okay, so we'll start. Today we will. So, if for those of you who are there, the reason that we took some breaks in the middle because there was a series of long weekends and um, around Aurudu, no one turned up. So then I thought there's no point in me having a lecture without any person. So we decided to we switch to the week nights to see whether that works. And anyway, now since everyone is sort of on lockdown, we can continue the weekend sessions. We have three more, so we are the last, we are at the end of the course, and we're looking at fintech. I will just quickly have a recap because I know that one, there is a break, and I know that several of you didn't join. And we're talking about fintech, so it's really important that you understand this, because there is sort of a conceptual side in distinguishing what fintech is versus traditional banking or traditional banking technology. So, if you have had a chance to go through the last lectures or had a chance to join us, can you just share, even if not, so I can just see where you stand and I can take it from there. If what is your idea of fintech? Anyone, it doesn't matter. Even if you've joined or read the previous slides, it doesn't matter. What is your idea of fintech? You all are senior bankers, so you already use a lot of banking technology. You also already use internet banking. So you all use mobile apps most probably. So how would you distinguish fintech versus other technologies? What is this big fuss about? Anyone? It's okay. And you don't there is no right or wrong answer here because these are new areas. So whatever you say is most likely correct. Gayatri, anything you'd like to add?
Good morning, madam. Technology related to the financial services. I mean, it's called as fintech.
Yes, yes. So that's what I meant. So that's the meaning of like the longer version of the word fintech. So you're correct on that. But when we take, why didn't we use the word fintech? Why did we started using this word fintech recently? I mean, it's a new word, right? So why now? Why did we not use this before? I think that's more the question. Well, what has changed? Is there something that we can distinguish between now you already have, I mean, like you have core banking, that's technology used in the financial system. We have ATMs, we have credit cards, debit cards. Those are all technology. Um, what do you all think this means? I mean, I'm sure in your banks, people have been saying this, they have been making presentations and all sorts of things. So just like just think you are first hearing this as a bank, not first hearing this in the course because you have heard this in the environment. um, what came up to your mind, or how would you make sense of it? Anyone? Dayaparan, Asela, Isivara? Anyone is welcome to give some ideas because I just want to know where we stand. Okay. So what we will do is let's do a recap of. Let me share my screen. And here we are. So I am going. Can you see my screen? So I'm going back to the lectures that we did on introduction to fintech. So we'll quickly sort of catch up on what fintech is, and then let's move forward. Can you see my screen?
Yes, madam.
Okay. So this was, you already have these slides, so you can also open them if you like. So so by basic, what I wanted to discuss in this course was the different types of fintech, benefits, disruptive technologies, and then country experience and how we can regulate fintechs, right? So fintech, now what Gayatri said, is technological enabled but innovation, right, in financial services that could result in new business models, applications, processes, and products with an associated material effect on financial services. Right now, this is what the US FSB came up with. Right now, the fintech by sort of by not definition, but you can say definition because they have included it in definitions, but by the intrinsic meaning, the what is internally, is not merely using digital technology for financial services, because that has already been done, right? Fintech really is where some you already have an existing digital setup, right? It's not necessarily from scratch. I mean, there is the new types of technologies that are coming up, but these are not sort of, from a greenfield situation. They are not starting generally from a zero position. They are using some existing technology. They will either use the bank's core banking systems, they will use a mobile phone, they will use the internet, some existing base, right? And they will combine some different types of existing technologies, right? Like the internet plus the core banking plus the mobile phone. They will bring all these things together and come up with like new applications, right? Things that were generally not done in traditional banking, or using these technological, the way these different technologies can connect with each other, right? The core banking to the mobile application, like directly it might not connect, but they will have all sorts of like gateways and ways to link the two, and they will come up with new business models, right? And then sometimes totally new products, and this way the traditional idea of banking or financial services is not what is being given, right? So there is something new, right? And this is connected through these existing technologies coming together, right? So this is the word fintech is, though when we break it up, it has sort of a very obvious meaning like financial technology. Actually, it's talking a lot about services that are connected to the internet, right? And connecting financial services to many untouched markets, or through bringing new products through the internet, right? So the internet has a big relationship with what we today consider fintech, right? Give me a sec. I need to draw the curves. It's very bright in the room that I am. That would be better. Sorry about that. So really, that is it? Can you see? Is it very dark? Let me see how you see me. I can't even see how you see me. Oh, I can't even see myself. It's fine. You don't necessarily need to see me. You can look at this. No, where are we? I just sharing this with you. Right. So this change in the business model, and I really want you all to grasp this, because going forward as bankers, right, um, or as anyone who, if you can continue to work in the financial service industry, this word fintech, the concept of fintech, sometimes in the future we might stop using the word fintech, right? But we need to be able to distinguish what fintech is and not what fintech was. Now, I have been to, like, I remember in about 2018, I went to a conference, an international conference with a lot of senior bankers, and they were very sort of annoyed by the word fintech, because they were like, why are they calling fintech? You know, we've been using financial technology for all from the beginning, so that is all fintech, right? And I won't disagree. There is no particular reason to go and disagree, but there is a reason we should also, when someone is using a new term, right? So there is also this talk of, okay, is this sort of old things with a new name, right? And but it is not really, right? And that is the important distinction that we need to make, that it is not the closed, now, core banking systems, the ATM access, all of them used to be closed, right? So if you are in the bank, that bank will connect it, and then sometimes central bank or interbank, there will be interbank systems. But those are all closed systems, right? They're only people who have sort of buy into that or to procure those systems can use those systems, right? But increasingly with the internet, we are able to combine internal and external parties, right? So banks and third party developers, right? They don't need to become a bank, a part of the bank. The bank doesn't need to procure their services, right? They can have a normal business relationship as an outsourced service provider or just a service provider, and through the internet that they can connect this link, right? And that third party will create a whole new product. It could be a payment product, it could be a budgeting product, it could even be an internal data processing product. There could be so many different things. Sorry, uh, that third parties can provide using the internet. Also, using the internet, the banks can have fintech. The bank themselves can have fintech. So they can connect to customers through new delivery channels, right? And not the way that they traditionally used to connect to the customer, right? And it is not just an extension of the banking interface. I mean, yes, internet banking is also considered a part of fintech, like a very low tech, low end, not a sort of a sophisticated end of fintech, but it is also a type of fintech because it's fairly recent and it uses the internet and all of that. But if a bank extends something, right? Now let's take bank has BOC has Smart Pay. Is that a fintech or not? Is Smart Pay a fintech or not? Anyone? What is the answer? Is Smart Pay, is BOC Smart Pay, the Smart Pay app, is it a fintech or not? Anyone would like to just it's, don't worry, whatever you think the answer should be. So it's a fintech. Okay, so you're saying it's a fintech. Is where I see that you still don't have a microphone. So it would be nice to talk to you. So why is it a fintech? You can type your answer. Just anything, it's fine. So your initial answer is correct. Yes, it is a fintech. Why do you think it is a fintech? Now, what, based on what we discussed, why is it a fintech? Yes, Asel.
It facilitates some more financial transactions transacting digitally through its core banking system.
So what Smart Pay does is, I gather you're from back of Ceylon, right?
NTB.
Yeah, Asel is from, you're from NTB. I think Gayatri is from back of Ceylon. So um, so now we talked new product, the internet, existing different technologies, right? And then new products, right? So let's take that and let's break down smart BOC smartly and decide whether it is a fintech or not. Right? Now, is it using the internet? Is it using the internet? It's a mobile app. Right. So that is yes. Uh, so the customer connects to the bank, the app via the internet, right? You download it via the internet, and then your connectivity is via the internet. You're not going through an internal banking portal or anything like that, where you have dedicated cables drawn to your house or anything like that. You're using normal internet, right? And then the other thing is it a using some existing technologies, some new technologies to connect to the customer in a way that they hadn't done before? So then the answer is also yes, right? So let's go to our set definitions that we were looking at, right? So describes general connection of modern and mainly internet related technologies such as cloud computing, mobile internet with established business activities or financial services, right? And then earlier definitions, they say that could result in new business models, applications, processes, and products, right? So back to smart pay. So now it has the internet. It has the mobile device, right? Now, as Asila said, it's connecting to the core banking system, which is the established business activity of business activity, which is providing payments services through the bank account. But now, what has changed? Now, earlier, how could we have made a cashless or any payment, cashless or cash, whichever, the account details being stored in our core banking system, right? How could we have paid using the money that was in our Bank of Ceylon account, right? Before Smart Pay is a mobile payment app. Um, what ways could we have paid a merchant using the money that we had in our Bank of Ceylon account?
Either by cards or physically going to the bank branch.
Yes. So either we needed a card, or that you are very correct, or we needed to physically withdraw the money from the ATM or from the counter and use that money. But now with the Smart Pay, we have a new product, right? We have a new product. We no longer need a card or to go to the bank account, or we don't need to carry cash. Directly from the phone, from our own phone, we can now make the payment, right? So now a new product has emerged, right? Now that is where this whole, when all these things come together, that is where the fintech is. When all these things have now come together, that is the fintech. It is not one, it is not the mobile phone on its own, it is not core banking technology on its own, it is not the internet on its own. It is when all of these things have come together and a new product or a business model has emerged. Now, the word business model. Now, is there a change in the business model? Now we have three ways to pay from our BOC account. One, we can withdraw money from over the counter or from the ATM. Two, we can pay by a card issued by BOC. Three, we can pay from the app. Can someone describe what the three business, because there is always a business model everywhere, right? Your banks are businesses, they need to make money, right? What are the three business models there are, and what are the parties in those three business models? Now we don't know whether, let's assume that Smart Pay has been developed by Bank of Ceylon internally, by the Bank of Ceylon IT department. Only they have developed Smart Pay, right? So then there is no third party there, right? So with your knowledge, now we have learned about cards, the parties involved in cards and all of that. So how are these business models changing from one to another? Any idea, any guesses? No, already I gave you an indication. I said Smart Pay has now been developed internally by BOC. Anything, just and you can make any guesses, because I really want to you all to grasp this difference. It's a very nuanced, it's a very small difference, but it has a big impact. Now, okay, when we take a business model, that means how is through that product or service, how are we making the money? I mean, that's the very simple definition of a business model. How are we making the money, and where is the profit, right? So, what it's very important, we often forget that banks are businesses, right? When we are, all of us, when we are in the banks are so large, and we do such a small part of the large banking service or process, right? We forget that these are money-making businesses, right? They need to make money, and like every other business, each point that they're making money. So yes, every point is a business model. There's a cost involved, and there is hopefully, it's not only a cost center, there is some related income, right? Now, over the counter, it used to be just a service that banks used to provide, but now y'all charge, right? I think almost all banks make a small charge for over the counter payments, withdrawals. Y'all, do you all charge a fee?
Yes.
Yes. Yes. Dapper? I think Dapper is on there. Gayatri?
Yes, ma'am.
You also do. Isivara, are you from a bank? Sorry, I forget. Okay, so let's go as yes. So that is one business model. Yes, okay. You're from a Standard Chartered. Do you have do you only have corporate customers now? At Standard Chartered? Ah, okay. Right. So do you also charge for over-the-counter withdrawals? Okay, so that we have, yes, one is making money from customers withdrawing their own money and keeping the money. This is always something I found interesting, because customers keep money with the banks, right? And the banks are already earning from that money, but they still charge to let the customer access their money, right? So you all can, as bankers also, you all can think about it, right? These are the sort of questions that you all need to really think, right? Is it correct? What does that mean? But I think most banks, the reason that they give is they want to encourage cashless, but for cashless also they charge, right? So yeah, that is something for you all to think about. What do we do as bankers? So then the other one is the next. We have the card. Card has Visa and Master, so there are other outsiders joining in. Then there is the acquirers and the whole model, right? So that is a different business model, right? So paying through the card is a completely different business model because it has the card companies. If it's not on us, then you have the other bank, right? The acquiring bank. So then your business model changes there. And if we come to, so that is cashless, right? If we go to smart pay, assuming that all the development was done internally, your relationship is, if it's your own customer, right? If they're paying a Bank of Ceylon customer, Bank of Ceylon merchant, and a Bank of Ceylon customer is making the payment, then it's just an internal fund transfer, right? So you're saving everything that you're paying outsiders, right? So you have a cost saving there. And if it is a SEFS transfer, right, if it's just pay transfer, then you're going through Lanka claim, right? So then there you have that the just pay whatever payment that you have to make Lanka clear, right? For the customers, it's still not, there is no charge. So this is how the business model has changed, right? So through introducing Spark Pay, you no longer need to go via a third party. You can go, if it's not an interbank, you can go completely internally, right? Or you can go through the locally routed Lanka Clear system, right? So your business model has changed. And this is what we mean by this change in business models, right? So these are the ways when we see something new, when we see a new innovation, we have to see, is this an innovation? What is new here, right? Has the business model changed? Has the delivery channel been changed? Are they using some technologies? Are they combining different technologies? Are there cost savings, right? Are there efficiency savings that weren't there before, right? And that is how you gauge whether something is a fintech or not, right? Is that clear? Any questions? I'll just if are there any questions on that? I want you to be clear on this because I want you to be able, really, this is the purpose of the main purpose of this course, right? I can just teach you, okay, these are fintechs, this is benefits, these like that, but I want you to be able to go out and if someone asks what is a fintech, you should be able to answer, right? So these are all sort of introductory things that we discussed last time. This is the rise of the smartphones. This is the interest, right, from 2004 onwards, how the interest of the word fintech had grown up. And then this is why you need to learn what fintech is, because there is so much money going into fintech companies. These are not banks. Banks are also investing in third-party fintechs. You may or may not know, but if you go and ask, if you're not involved directly in the IT and the innovation, digital innovation arms in your banks, you can see whether they have acquired, some banks have acquired fintechs, right? Sometimes even the apps and all that we see are not developed by the banks. They have acquired a third-party app. And this is very common throughout the world because for banks, Sometimes it is much easier to get a third party, an innovative third party developer to come up with the app rather than asking their bank employees who are already busy with all their routine work to come up with an innovation, right? So this is but there's a lot of money going. This is billion, right? We're talking about US dollars billion, the investment in fintech, right? And this is the global interest in fintech. So this is why you need to, going forward, you need to be able to grasp what this big fuss is about, right? So fintech covers many areas, right? So some of the popular areas are mobile payments. Payments is one of the first, and then there's crowdfunding, robo advisory. They all fall into the very large umbrella of fintech, right? Insurtech, that is for insurance. Regtech is for regulation. So if you do compliance and with whatever other banking regulations that you need to comply to, there are now systems, it's called regtech, to ensure that the banks are complying to all the regulatory requirements. So that is also falling under the larger area of fintech, right? And then the technologies, the underlying technologies used for financial technology is not just only the internet, right? Within the internet, there's a lot of additional technologies that are being used, like artificial intelligence, right? Big data, then the robotic automation, right? Blockchain. Sri Lanka is also studying blockchain to use blockchain. So there are a lot of concurrently. Uh, so the fintech is more the service, right? And then there are a lot of new disruptive technologies that are enabling fintech, right? So it's that's a big area that is getting covered here. Other types of fintech we will discuss. So open banking, digital wallets, asset management, digital banking. So these are all different types of fintech, right? So it's so vast. What is taking place in financial services is so vast due to the internet and the new, like the flexibility of technologies, how technologies can be linked, different types of technologies can be linked and how they become interoperable. That is really changing the financial industry and even the types of services that are available, right? So I'm just going to go through this just to sort of high level. You can listen to the lecture. These are the examples of crowdfunding and uh, so robo advisory. Some of you do have. I've seen in some banks there are these chatbots that come up. Do your banks have chatbots? Like when you go to the internet banking site, they say, "Can I help?" and does something come up in your banks? No, none of your banks have it. So some banks, if you go to a normal, like even if you go to, I think, normal websites like Kapruka or Daras, you will have that screen coming up, right? Can I help? Um, and so those are very basic types of robo advisors, right? The chatbots are like very sort of the low tech ones, right? They kind of work like a search engine. But robo advisors can be very advanced, where they advise the customers on where to invest. They will invest on behalf of the customers. They will have algorithms, right? Now, even the very, get that example here in this, the Schwab's, right? Let me see whether I can show this to you. This is the right one. So Schwab is a very old U.S. investment bank, right? It's called Charles Schwab. It's here's the name. It's specialized in that, and a lot of people in. So we haven't heard this name. I don't know whether you all have heard the word Schwab. It specializes in investment, and there are a lot of relationship managers and all of that. And they are very traditional, but they themselves introduced robo advisory. Now, this is how it's the financial industry is changing, right? So for customers that who don't want now in investment banking, you will get a relationship manager who will look at your portfolio every day. They will look at the stock market and decide, okay, I will go and reinvest these stocks in this way. But for those who don't want that, they provide robo advisory, right? So the robo advisor builds, monitors, automatically rebalances a diversified portfolio based on your goals, right? Now it charges less than the human advisor, right? So it's based on an algorithm. You will say, okay, I want 50% what in treasury bills. I want 20% in all these precious metals. I want 20% in food or in something like that. And then the robo advisor will continuously work based on that algorithm and do the investment for you, right? And it gets they say start as little as $5,000. So this is how the environment is changing, right? um, it's very important that we know this because it might not be happening in your banks already, but these are already banks are looking at artificial intelligence and to see how these low cost models can be brought into. And in that light, you need to see what is your role. Where are you going to be the decision maker? Are you going to be the one who learns these new technologies? Are you going to be the one who's going to move out of the industry? So you really have to see because all this change is coming about, right? There again, now if we take RegTech, right? RegTech uses technologies such as advanced analytics, robotic processors, and cognitive computing to achieve regulatory and compliance outcomes, right? So, some if your compliance already, most of you all have compliance softwares where okay, if a customer's transaction is beyond a certain threshold, there will be a flag or some alert system. But these advanced regtechs, they can use data analytics and see whether any compliance issue can get captured, right? So they are sort of more high speed and more advanced, right? So that was the first of the introductory sessions that we had. Any questions so far? Any questions? Am I going too fast? Is it clear? Because I really want you to understand this one. Right. So in the next fintech, in the next session, so Savan, I did it in two parts. We had two weekday sessions. So here, what I've done is I put it down in diagrams. Because I want you to sort of understand this better, I put it down in diagrams. And there is this cartoon which is so this is a KYC process, right? RegTech, right? So everyone is talking real time. We need higher efficiencies. It should be faster and all of that. So this person is coming in and asking, do you think it's a stretch if we call our onboarding process real time? So this is the way that they are processing the documents, right? So the question of what is real time, what is efficient, right? What is low cost? And so can we stretch this use of technology? Paper is a technology. So where do we draw these lines, right? And so these, I think all of you know, these are the basic models of cashless payments. So in these diagrams, what I've sort of pointed out is where is the fintech happening, right? So it's where the traditional models and someone comes in the middle to change the business model. Can someone explain this to me? What have I drawn here? Why is the payment service provider needed? Have you just unnecessarily gone and complicated a simple process? What are the advantages of having this payment service provider here? Do you all know what this diagram is? Minus the internet payment gateway minus, okay, this one. Sorry, this one. Ah, very,
Madam,
very basic.
can't see the diagram.
Yes, so you know this diagram well, Asela. You presented to us as well, right? So now, can you tell us what is changing in the next diagram? Where has this fintech come in, and what has happened to the normal card process? So what has happened? So we traditionally had the POS machine and the card, right? And now because of now this is an example for smart pay, right? Now this guy, we don't need this anymore. We have used financial technology, and through the customer's phone, they are directly making an NFC payment, right? The POS machine is there, the card has disappeared, right? You don't need the card anymore. Directly from the account we can go, or directly from, you can embed the card details into the app as well. So the plastic, so if we do that, then who is really losing out? The plastic card manufacturer and the chip manufacturer, right? They are getting thrown out of the value chain from fintech. That is what is happening, right? Customer doesn't need to carry another card. No one needs to, there's no contact, right? It's a contactless payment. Now this is the fintech. This is an existing technology, the mobile technology, existing technology of the POS machine. Small development has been made to make it NFC enabled, right? This also is using the new smartphone, already has the NFC capacity. So now these two have linked. That interface has changed. Now that is the fintech there, right? Now we have the online payment, right? So when you make an online payment, then it goes through an internet payment gateway that is provided by the bank, right? Do you all know that? Anyone doesn't know what a internet payment gateway is, IPG? Um, do you know what an internet payment gateway is? Yes, no? Okay. Right. So the applicant is saying yes, I will take that as a yes. So the IPG is provided by the bank, and that is the link between the merchant and the bank via the internet, right? So that enables the merchant to, so instead of the POS machine, it is the IPG that enables the merchant to take down the card details of the customer to initiate the payment, right? So IPG replaces the POS machine when it comes to online payments. Now we have this guy, the payment service provider, who is coming in front of the IPG, right? Now we in Sri Lanka we have WebEx Pay, Pay Here. Those are payment service providers. Now what are they doing? What is their job? Why have they suddenly come in the middle here, right? Why are they now? They have made it longer, right? They've come in the middle, and why we are calling them fintech? What is this? Can someone explain? Does anyone have any experience with? Have you seen a IPG? Sorry, a payment service provider when you've gone to pay? Now, when we go to buy online, sometimes we directly get we go into a bank IPG. We can see that it is connected through the bank, right? But sometimes when we are going to pay, we will see we are going into a WebEx Pay payment page or a pay here payment page, right? That is when there's a third party. Now, the advantages of having a third party is that the third party does the the security related work, a lot of the compliance related work that otherwise the bank has to do, right? So instead of the bank having to connect with each and every merchant through the uh, and do the merchant level developments with each merchant, right? They can tell the payment service provider will do that on behalf of the bank, right? And the payment service provider will take the risk. So what happens is then merchants also, sometimes it's difficult for merchants to get the IPG because they need to show a certain level of funds, certain level of technological capabilities, and the merchant also has some level of higher compliance. But when they're going to the PSP takes that risk, right? So the link between the bank's system is protected by the payment service provider coming in front, right? They will take whatever risks that are coming from the merchant side, and that risks are not getting transmitted to the bank side. So that is, and for the merchant also, it is easier to get a connection via the PSP because they don't have to make the high payments or the high investments that they would have had to do with the banks, and it's easier to do with the PSP because the PSP is only doing that job, right? They are only facilitating internet payments for an internet payment gateway. So that just makes life easier for the merchant as well. So for both the bank side and the merchant side, that it is easier when the PSP comes as an intermediary, right? So the PSP is an intermediary. The bank is, I mean, there will be PSP will charge from the merchant, bank will charge from the PSP. Will be all sorts of models, right? But the service that the PSP provides expands the market, right? So it changes the business model because it is allowing low-end merchants to join in, low-end sort of higher risk merchants to join in because the PSP is doing the compliance work and whatever safeguards are required, the PSP takes that responsibility, right? So this is why how this person in the value chain, this person coming in is the fintech there. All of these are been in existence. These are all there. Right? This is also one way of fintech, but this has already been there. So this coming in is the fintech, how the business model changes. A new actor has come in. It's using internet, it's using existing technologies and innovating a new service to increase the efficiency and expand the market that of people using online shopping, right? The merchants using providing online shopping, right? So that is what fintech has come in. Right here again. Now this is a now these are front ends, right? So these are front end. So this is directly with the customer, right? Now still directly with the customer. Right now, these are now we are going slightly to the back end where fintech can happen even at the back end. So it's not only front end innovation, right? Where we find some new connection for to make a process more efficient or create more value, right? So the national card scheme, we have studied the national card scheme before. This is now what is happening. Local transaction is going via Lanka Pay. International transaction is going via JCB, right? So we only pay for the foreign exchange part for the JCB leg only, for the foreign leg only. Now locally, if we use Visa Master, for each transaction, the money is going outside. There is a transaction fee going outside the country, right? But with Lanka Pay, they distinguish: is it a local transaction or a foreign transaction, then it goes through Lanka Pay if it's a foreign transaction, right? Just Pay is also a infrastructure level fintech, right? So we have the CEFs, but with this development, the Just Pay development, we can directly access our bank account via our mobile phone to pay, not to fund transfer, but to pay the merchant, right? Yeah, LPOP is another such interface. It changes the interface of how to access. So instead of just making a fund transfer to customs or IRD, there is a easier interface to for the customer to directly pay these services, right? So basically, fintech provides a new layer, right? So those are what we discussed, and then we just touched on what are the benefits. We will expand on it later. So this is I wanted to sort of just recap for you all before we go to today's topic. This is some because we are going into sort of I wanted to go into sort of a more deeper territory. Any questions? Anything that you feel unclear, which you like if they were clear නැත්නම් just ask, because I'm going into sort of more deeper theory today. So it would be good to know where you stand. We haven't had theory as such in this course so far, right? Because a lot of them have been sort of a explanation of what's going on. But today I want to discuss with you why things happen and why we call certain things that it is, because you all can, what I want you to be able is to identify fintech and also identify strategies, right? So you're like executive levels, so senior bankers, so you should be able to understand the wider reasons and strategies as to why things are happening. Any questions so far? Any questions? Okay, let's take. I'm a little tired. Sorry, these days I'm not well, feeling very well. We will take a 10-minute break, and shall we return at 10:20? Thank you for that. So I have to excuse myself. I'm not feeling very well. I've been on medical leave for the past 2 weeks, so I'm just sort of slowly recovering. So I'll be a bit slow on this because I feel a bit tired. And we'll do the theory part and we'll see how it goes. But we should be able to finish all what we planned within the next 2 lectures as well. Right? I've asked Kalinga to share with you the email of today's slide. So if you want to use that, you can use that. Please ask if you have any questions because we are, as I said, we are going into a theory section. So it's important for you to grasp this, right? And the reason we are going into this theory section is the course name is Fintech Innovation, right? So you not only should know what fintech is, but you should also know what innovation is. So if you look at the structure of this course, I've discussed what digital is and what not digital is, what payments is. We've discussed payments in a long this thing, and we've discussed now what fintech is and how we can identify fintech, right? And then the next point term that we have in the course is innovation. Now we must understand what innovation is as well, right? And how do we distinguish these innovations? Now you all are senior bankers, so it's not just saying, oh, fintech, fintech, fintech. But then what is fintech innovation? Are you doing fintech innovation or are you doing plain fintech? are you doing only digital payments, right? We must be able to distinguish what we are doing. It is only when we understand what exactly that we are doing, we can be successful in it. Otherwise, if you are just doing payments and you think you are doing fintech and you're expecting the results of fintech through just doing normal payments, because fintech is financial technology and payments is now digitalized and there is technology, if you are expecting the same result by labeling what you have done wrongly, then you're not going to get the expected result, right? So it's very important that we are able from the onset to distinguish what these things are, right? And this course really is that process of expanding your knowledge of what is out there, what is happening in the world, where things are going, and giving you some tools to be able to identify when you finish this course and go out, right? As you are in this course, you should be able to look at the world, right? When you see app or some new thing, in your bank, your digital people might say, oh, we are doing this. KYC people might say, oh, we are doing that. And then you must be able to critically look at that and say, is that actually what they are calling it? Is it actually fintech? Is it actually innovation? Or is this just is there anything innovative here? Is it just copying? Are we just copying what someone else is doing, right? And that is fine, because in the market, sorry, there's a mosquito in there. And in the market, because you have to be able to compete by provide. Sorry, this mosquito might just die. Uh, sorry, and then you will your bank might be copying or sort of doing what the other banks are doing, and that is fine because you all need to be on par. But if you're innovating, that's a different discussion, right? So who is there with us now, right? Right, can you see the screen? Can you see the screen?
Yes, madam.
Okay, right. Asel, before we start, I'd like to ask you a question. Oh, Kalinga. Oh, ඇවිල්ලා නැද්ද? එන්න මම බලන්න. Give me a sec. Kalinga hasn't received the PowerPoint. Let me just. Right. Can you see the screen? Yes.
Yes, madam.
Okay.
Yes.
Right. So, Asel, I just wanted to ask you, because you've been in the banks for some time. In your mind, like, obviously, I think each bank uses the word innovation. What, in your idea, is innovation?
That means to me being the early bird like thing that we need to be different from the competitors and find new ways of, I mean, if when it's come to banking, finding new products and maybe when it's come to again digital platforms, the fintech innovations, being different from the rest.
Okay, so that is actually, I think that is a very good, simple way of trying to explain what innovation is. It is a very, it's it's a big term. It's in the sense it's different people give different definitions, and I think the part that you have captured is correct. It is being different, right? So then let's see what we have, right? So when we talk about innovation, right, we have two words. Now, what is the difference between innovation and invention? What is the difference between innovation and invention?
Invention is something you investigate and finding something. Innovation is, as we discussed earlier, being different.
So now, who invented the light bulb?
Thomas
Edison.
Alva.
Right,
Thomas
Edison.
Alva.
Right. So he invented the light bulb, right? So light bulb did not exist before Thomas Alva Edison created it. Right? Fire was there, light was there, but capturing the light onto the tungsten, right? The wire, and holding it there to so that it illuminates without burning off for some time through electricity. That was invented by, and that was also safe, right? So it was safe. It had iron casing, and Thomas Alva Edison did several trials, and then he came up with the sorry, there is a mosquito in this room. And he invented the light bulb. Then we have subsequently we have energy saving bulbs. We have fluorescent bulbs. Now, are they inventions or innovations?
They are innovations. The first finding is the invention.
Exactly. So this is what we need to distinguish, right? And so this is where the thing that you were trying to say of being different, right? This is where the difference comes. So to become different, there must be some starting point, right? So inventions or the first the creation of something is the starting point, and then subsequently we come up with innovations, right? So innovation generally is the general definition for innovation is the recombination of existing technologies, right, to generate new outcomes, right? You might there will be new additions, there will be new components coming in, new raw materials sometimes, new knowledge coming in, but there is a basis that it is starting from, right? It is not a solely new out of the blue thing, right? It is coming from something else, right? And innovations can take place in the forms of business model, technologies, products, services, practices. Anything can be innovated, right? So it doesn't necessarily have to be only the technology, right? So this distinction is important. It's not only the technology. Now, when definition on fintech, also you can recall that definition had words like business model, product, services, applications, processors, right? So any of those innovations can happen. But now that is a very basic definition of innovation. Now innovation has been studied quite a bit, right? It's now been there in the world for about 20 odd years. So it's been studied quite a bit. Every innovation is not the same, right? Um, and different innovations bring out different responses, different outcomes, right? So now Harvard Business School, they have studied this a lot, and much of this lecture is based on their academic research. And also, I want to talk about this concept of disruptive innovation. Have you heard the word disruptive innovation? Have you heard of the word disruptive innovation? Has anyone
No,
heard?
madam.
You have heard?
No.
You have.
I guess it's being without interrupting. That means continuous innovation.
Sorry?
Is it continuous innovation?
Disruptive.
Yeah, disruptive innovation means to continuous innovation.
No. Continuous innovation would be sort of the opposite of, not opposite of disruptive innovation, but different to disruptive means something to disrupt means to disturb something, right?
Yeah.
So it's a very, anyone else heard the word disruptive innovation? Anyone? No. Let's do a Google's. Can you see my screen? I just want to see.
Yes.
So Google Trends. Google Trends, Google Trends. Let's see what Google Trends. Now you can see disruptive innovation. There is a increase in Sri Lanka. This is only Sri Lanka. If we take the world, right, there is a path of disruptive innovation, right? If you take Singapore, Singapore has the highest use of the search term disruptive innovation, right? And then let's just go to just a normal Google search for disruptive. I just want to tell you what the reason I want to show this to you is when you are studying disruptive innovation. Let me see whether we can get on images. Here we are. So this is an article that much of your lecture is based on this article because it's a simple article of a bigger study, right? There is this book. Can you see from my camera? So this is called Innovators Dilemma, right? It's by this author called Clayton Christensen. He's a Harvard professor. He actually passed away recently. So he sort of is the sort of the father of this disruptive innovation concept, right? He is the one who came up with this idea, and a lot of these new fintechs, Uber, Netflix, they all say iPhone, they're all considered disruptive innovations, right? And so we will now learn. I might know. I'm not good at killing mosquitoes, but this thing is really annoying. So we are learning what they showed as. So this is which the image was there, right? So in this, now if you look at this, the term disruptive innovation, right? It's part of the business lexicon, and the dramatic growth in the number of articles, right? And you will find sometimes if you go to innovation literature, into these seminars and all of that, they will use this word disruptive innovation quite a bit, right? And so we will learn what is this disruptive innovation, right? It's a very popular term, right? So when we take innovation, there are in academics they have identified four types of innovation, right? There is disruptive innovation, there is architectural innovation, routine innovation, and radical innovation, right? Now they have grouped them into four types of innovation. Now, if you take disruptive innovation, they are the ones, now it's a matrix here, right? When creating an innovation strategy, companies have a choice about how much to focus on technological innovation and how much to invest in business model innovation, right? So when we are looking at as banks, when we are looking at coming up with new products or improving an existing product, going into a new market and using digital technology, right? There's a huge budget on digital technology. We must not just think, oh, we must put in all our efforts into digital technology, right? And get the best software developers, get the biggest IT procurements. That is not what needs to be done. We must always assess which technology is how much of the technology we need, right? Especially nowadays, because technology is much cheaper, right? So sometimes you don't need large procurements at all. You just need your normal laptop and a phone, and then you can come up with new technologies, right? So we have to decide what do we need these technological innovations. Then how much do we need to invest on the business model innovation? Because just having new technological innovations doesn't work. Now you might have seen now your banks sometimes might have tried to introduce new apps, but customers are not adopting them. Right? They have failed. Right? You see all these. Sometimes you might see your children, your friends' children. They are saying, "Oh, we are developing apps," but they are disappearing. It's not successful. Sometimes you will see someone who has done something very simple, but it is very successful. The technological side or whatever the product that they have come up with is very simple, but it is very successful because they have innovated on the business model, right? The business model is innovative. So we need to identify where do we need technological innovation, where do we need business model innovation, right? So these things are not cut and dry. It's not straightforward. We have to be very smart when we are making these decisions. It's just running behind things saying, oh, let's innovate, oh, we are going to get a lot of profit is not going to work. Even banks, when they're coming up with apps, if they're going to procure an app, just because a app developer comes and says, oh, look here, it's this nice fancy app, it's very innovative, it's very beautiful and easy to use, it doesn't mean that it's going to be successful, right? So we have to be able to identify what is the need and where do we need to put our investments in, right? Now, do you remember when FreeMe launched? I don't know whether you all noticed this. They gave a lot of cash back. Do you remember this, any of you? When NTB's Free Me launched, they had a lot of cash back for about, I think, even more than a year. There's huge cashbacks when every time people spend, they were giving cash back.
Yeah, yeah,
Yeah.
yes,
So that means now it is not the technological innovation is not the issue here, right? The app was working, right? But they knew only having a nice app is not going to get customers, right? So they went into their business model, they changed. They gave a lot of discounts to the merchants, so that the merchants will also want customers to use Freeme. They gave the customers cash back so that the customers have some incentive other than the convenience, the efficiency, or anything of the app. And that's why most people adopted Freeme. If you take a lot of the young people, they adopted Freeme because of the cashback. If you ask them, and we have asked this question from people who have adopted Freeme, and then why did you, especially those days, not new customers. Now they don't have so many cashbacks. They were like, it is for the cashback because the cashback for them was more valuable than any other efficiency that they were getting. Right? So you need to understand your innovation strategy. Where do you need to draw the line for technological innovation, and where do you need to innovate on your business model, right? Mm. So now we have 4 types. So disruptive is one. Now, for what we call disruptive is where it requires a new business model and leveraging existing technical competencies, right? Is new and existing. Now, then there is routine innovation. Right now, what the examples for disruptive innovation has been now open source software. That is a very common model. Do you know what open source software is? Have you heard of the word open source software? Anyone? Have you heard of Open Office, like Microsoft Word? Have you used Open Office? Anyone? No? Right. So this is very important, right? If you don't know what open source software, you need to know what open source software is. Open source software is free software, right? It's free. Now, Microsoft, we need to buy license, right? Apple, when we buy the Apple, the iOS is there, we are paying for it. Now, open source means it's free. That is, software developers of the world over, they have come together and they come up with, they develop software for everyone, right? It's free of charge. The source code is open, so any software developer can come and improve it. They can all come and improve the software, right? So any bugs, anything, they can develop it. Now, Google is also based on Linux, which is open source, right? Now, we think Google is proprietary. Actually, it's based on an open source software, right? Wikipedia is a encyclopedia format of open source, right? So, Wikipedia, if we go to Wikipedia, we all know Wikipedia. So let's go to Wikipedia. I just want to simply show you what this is. This is important for you to know. Right? So if you go to Wikipedia, right. Now this is Wikipedia, right? And now we can see all the sources, everything are clear, right? Now we can see people can make changes, right? The contributors can make changes. If we go to a topic, let's say Sri Lanka, we are here, and if we go to this, right? Now here people have made their contributions and changes. Now this is because it is open source, right? Anyone can come in and edit. Here, now these are all, there is a link who has done it, when, which, what time, right? Now until yesterday, there has been a change on the Sri Lanka Wikipedia page, right? Right now, if you go to some of these, in the, not in this one, in some of these discussions, there will be all sorts of disputes and all these things happen. And that is open source, right? That is because Wikipedia is open source. Anyone can join and contribute and improve. And then people will check and dispute them and anything like that. No, that is open source. Now, what open source did was, it disrupted the proprietary license system, right? Even though many of you, when many of us use proprietary, like me, MS Word and all of that, there's a lot in the world who don't use those, right? For various different developments. If you take, if you have you heard of the company WSO2 in Sri Lanka? It's a fairly large IT company in Sri Lanka. It solely uses open source. All their products are open source. So it's open for anyone to come, any software developer from this world to come and develop it. So the development is getting done almost free of charge at a certain point, right? So these are new business models, right? And they are using existing technologies. And you will find, if you actually speak to your IT people, they will be using open source software. They don't have to pay for them. And they just have to give credit, saying that it is an open source license, right? And so that is disrupting the existing proprietary licensing of software companies, right? And it is now freely available for anyone to use. And video on demand, like streaming, YouTube, Netflix, right? Instead of people going to the video shop and getting the video or the DVD, now online they can directly stream. The business model has changed. What are the existing technological competencies that they have used? What are the existing technological competencies they have used? So this is very straightforward. YouTube versus DVD rental. YouTube is the one that has now disrupted DVD rentals. Can you explain the business model? Business model we said. Now, how did YouTube use existing technical competencies?
Through internet?
Yes, internet is one. So digital video, right? People can easily make videos, right? So there is a connection. Now our cameras, our normal, from our, if you remember, even our little, those digital cameras that we got, right? They were able to do videos. Then these camcorders, we were able to have digital videos. Normal people were able to make digital videos. Videos became digital. They were no more VHS, right? They became digital. Even DVDs, that it was digital, right? So all these videos, we can now, there are this digital video content that is available, that the computers have. And with the internet enabled a system where you can upload these digital videos for everyone to see onto websites, right? They can host these videos. Now these are all existing technologies that were there. They were existing separately. People were able to make digital videos. Videos that were getting made, like films and all of that, were also coming in digital format. And then the internet, coincidentally, was able to upload and host digital video content. right? So YouTube put all those things together and enabled people and companies to upload films or whatever digital content that they wanted onto the YouTube site, and where they can show it to everyone. And the real connection, and the reason I said YouTube is because it is more popular. If you are using Netflix, Netflix is the real Netflix and similar things, streaming lines to like Amazon Prime and all of the Amazon Video. Those are the direct disruptors of DVDs or videos, right? Which is that you still pay a rental, right? But you don't need to get a physical DVD, right? That is now where the disruption has happened, right? Now Uber is also one of these. Now Uber, we will discuss in the next slide. It doesn't fall um, into disruptive per se, but ride sharing services have been disruptive, right? Then we have architectural innovation. Now, which is architecture means the overall design of the way the thing is getting done, right? Um, so now, for instance, now medicines. Now they have given the example of personalized medicine. Now they are already making medicine, but now they are making it custom made, right? Now digital imaging, Polaroid, Kodak were on the their photographs were on the, what was it called, the film roll, yeah. But then they moved to digital imaging. The architecture is changing, right? So internet search of newspapers is newspaper is still there, right? uh, People are still reading the newspaper, but the way that they are accessing the newspaper has changed, and the physical nature of the newspaper has changed, right? So now it is bringing in a new technical competency. We are no longer putting the newspaper on the print, right? It is on the internet. Now that is an innovation. Now, we can't access the digital, when we go to the newsstand, we can't access the digital paper. We have to get the paper itself. But on the internet, we can access the digital format, right? So, this is another type of innovation. Then there are routine innovations, right? That is leveraging existing business models and then using the existing technical competencies. Now, this is these gradual innovations that happen. Now, as we go, every day we are not doing the same thing, right? Every day, we continually innovate. Even if you take a biscuit, right? If you take a Munchie biscuit, what we ate, the taste of the Munchie cream cracker is not the same taste of the Munchie cream cracker that it was 5 years ago, right? That is because they are constantly improving their product, right? So that is routinely they are improving their product. Very few products remain exactly the same. Even if you take Siddha Lepa, right? The Siddha Lepa itself may be the same, but the bottle has been changing. The way, the sizes, the way that we can use it, the way that we can access the product has changed. Right now, certain little innovations they make, right? And then also the way their propositions also change. Right, those days Siddha Lepa was only if you are not well, and then Siddha Lepa, when dengue mosquitoes were going up, they started telling people, oh, apply Siddha Lepa because the what is the citronella is good to prevent mosquitoes, right? So they are leveraging on the existing competencies, right? So one of the examples that is easier for you to understand is the cars. Now BMW has constantly, they are routinely, you have new series of cars coming out. Every car is like that, right? Now, if you take the Toyota Corolla, the name has not changed, but the car has been changing throughout the years, right? Then there is radical innovation, where there are completely new things coming in, right? Uh, it requires new technological competencies, right? Now, biotechnology, then using jet engines, uh, then fiber optical, right? Now, those are all, they are bringing in completely new things to their existing models. So the what we get as a result, now you take fiber optic, the speed has changed, but our computers and everything are unchanged. The way we get it is still the same, but the technology behind it has changed, right? And there is innovation there. Now, in banking, right, have we seen such innovation? Have we seen any of these innovations? Disruptive, architectural, routine, radical. Have we seen any of these changes?
In the clearing system, we had the image clearing came up in 2006-7 year.
Yeah. But where can we put that? Where can we fit it in? Where can we fit in the change in the clearing system, the check imaging in this matrix?
Infrastructure.
Hmm?
Infrastructure innovation.
Yes. So we have disruptive. Let's make this bigger. So we have disruptive innovation, architectural innovation, routine innovation, radical innovation. So this is the matrix. It requires a new business model, right? Did it require a new business model? Did it leverage existing business model? Or did it require, so I think this part, yes, right? So it's falling, it's not a existing technical competency, it was a new technical competency, right? So the introducing the uh, check imaging technology was a new technical competency. So it's definitely in one of these two, right? Architectural or radical, right? And I think it may fall, if I am not mistaken, I think it falls sort of in between these two, because there is a new infrastructural change happening, and there is also an architectural change happening, which is the check image itself, the way it gets transferred changes, right? But there is not a major business model change, right? In sense where the customer is concerned, it has not changed so much. The customer still has to go to the bank, right? From the customer's business model perspective, uh, the the customer still has to go to the bank. The bank still has to submit it to Lanka Clear, right? So Lanka Clear, even before check imaging came about, Lanka Clear still has to the check has to go to Lanka Clear, right? So first we sent the physical checks, then we sent it from the CDs, and then we had a system to directly transfer the check image from the bank to the Lanka Clear systems, right? So it looks like SITS was a radical innovation. Do you follow? Does that make sense?
Yes, madam.
Others, any questions? If this is too complex for you, feel free to ask, right? Because this is for us to all learn, right? These are all, there is nothing fixed in stone. You know, someone can do another study and say all this is wrong and there is another matrix and they can disprove this is like, these are all coming from academic research, right? So this is this is the source of this, right? So it's by Corning and Pisano. It's based on, developed from a lot of other research as well. So are there any questions? Are there any questions? Or are there any other, like, so Asila, the example you gave was very good. We were able to try and fit it into this to see what sort of innovation it was. So others, any other innovation that you have seen? We can even see whether what we think is an innovation is an innovation. You know, sometimes we might think something is an innovation and actually when we try to assess it, it might not be an innovation. So any other examples that you'd like to share with us?
The Momo merchant,
HNB.
yeah, innovated by HMB, yeah.
Right. So Momo, what it did was it I'm trying to remember what Momo did. Momo is where it allowed the merchant. It gave merchant iPads. Was it? Do you remember what Momo?
Yeah, through the mobile line, they could get the connection. All this time it has to be a fixed telephone line.
Uh-huh.
With the Momo device, they could connect to the mobile connection and get the merchant ship.
The POS connection.
Yeah, post connection. Yeah.
Right. Right. Okay. So let's just see where we can. So that's also a good example. See whether we have something. Are the others familiar with Momo? See if we can find something HNB Momo so that you know what HNB Momo is. Here we are.
Worry no more with cashless transactions. HMB Momo.
Can you hear the video? These are all the things I watch on this thing. Can everyone see the? Can everyone hear the video?
Way to accept
Yes, can hear, madam.
payments without using cash. Customers can pay with their debit or credit card for goodies. Merchants can easily receive money to their bank accounts. Call 0720 800 800 or 2462 462 today. HMB Momo is the safest way to accept payments without using cash. Customers can pay with their debit or credit card for goodies. Merchants can easily receive money to their bank accounts. Call 0720 800 800 or 2462 462 today. HMB Momo. Safe, simple.
Right. So that is HNB Momo. So thank you for pointing that one out. And interestingly, in Sri Lanka, still there are so few mobile POS machines. We see them very rarely. Sometimes, you know, Pizza Hut, they bring when they are coming to some delivery places bring the mobile POS machine, but it's very rare. In countries like UK, you have to, the mobile device is compulsory. You can't, now in Sri Lanka, they take the card and they go, when you want to pay by card, if at a restaurant, they take the card and they go to the counter. In the UK, you can't do that. You have to bring the machine to the customer and you have to, because the customer has to type in their PIN, right? So, and that whole transaction should happen in front of the customer. So you can't take the card. Even if you're signing, you can't take the card away from the customer due to fraud and all these issues. You can't take the card away from the customer. So, okay, H&B Momo, where can we fit this? Does it require a new business model? So the way the customer and the merchant connects to the bank, has it changed or not?
Not change.
Not changed. The still they are connecting. You still need a merchant account. You are still paying, so it is only the technology that is changing.
Yes, right.
So that also then there is a slight sense of that architectural thing of the business model slightly changing because it is going to the custom. It can go to the customer as opposed to the customer having to come to the landline mobile, but it is more sounding more like a radical innovation as well, isn't it? Where the technology, it requires a new technological competency where you're moving from fixed line to mobile. So I think now both the examples that we have seen from the banking sector are radical innovations, right? So then you have to figure out then where do we put in the where do I invest in the business model? Where do I invest in the technological competency? There is a change in the technological competency, right? So then you have to make sure that the relevant technological side innovations are taken care of even more than the business model side, right? Of course, in the business model also there is a, as you pointed out, Asela, the 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 merchants, they still need a phone connection, but they don't necessarily need a landline connection. There's a slight change there as well. So these are not hard and fast, like it doesn't only fit into one point of the matrix, but of course you will see more of the characteristic in one point of the matrix, right? Right. Are there any questions? We spent a lot of time on this, but the reason I'm asking you these questions and is so that you all try to see what is this difference. Without just calling something innovation. Right? We need to be a bit more nuanced in our understanding. We need to understand the details. When we use terms, we need to, because it's really, it gets really annoying when people just use everything they are calling innovation, everything they are saying disruptive innovation. It gets really annoying because they don't they're just using terms, and it's good if the other person also doesn't know what these terms mean. But when you just start loosely using terms, the bad part is you are expecting outcomes that won't come out of it because you're using the wrong term. You're using the wrong term, you are expecting the outcomes of that term, but what you're using it for is not matching, right? So any questions? No. Okay. So I am going to focus now. We've sort of spent time on this, and we find what are some of the routine examples for routine innovations in banking? Now, banking has routine innovations. Things that were done before have been slightly improved. Gradual, small, incremental changes, architectural changes, and routine changes both happen, right? Um, small changes that you all keep doing.
Enabling other bank withdrawals by ATMs.
CAS.
Yeah.
Yeah, CAS. So CAS also is it needed some new technology as well. And CAS also needed a new business model. It would be, I think, a architectural innovation, not only a radical innovation, because the business model has also changed. Because you went to customers went to new other banks. There was a sort of fees share, fees from the other banks coming to Lanka Pay, then the liability managers and all those things. So I think that it could be more an architectural innovation than a radical innovation, because it had a technological change and a business model change. Any routine ones that you all have seen from your experience, upgrades in the systems, changes in interfaces, anything that you've seen like that? Anyone else? Anything that you have seen? Interfaces changing to customers. So I think now if you take internet banking, right? Internet banking routinely they change, right? They upgrade and the interfaces change and the capabilities and the functionalities. I think Sampath Vishwa might be a good example for this. Where you have it is still the same internet banking, but they have a lot more services in the same interface, but there are it keeps improving, right? Routinely there are improvements. Right. Okay. Now we are going into disruptive innovation. Right. So the concept of now disruptive innovation, most the reason I'm highlighting disruptive innovation is because before we start disruptive innovation, do you all mind if I just take a 5-minute break, because I get tired a bit. Sorry about that. So disruptive innovation. Now, why have I selected of the 4 types of innovation that is sort of very commonly that if you look at literature, you will find different types, and someone else might use another combination. This is sort of the most popular. The Harvard Business model is sort of a most popular model for innovation, right? And I'm using that to teach, because we are not going into a deep study of innovation and what exactly is innovation and all of that. But I want to just give you some idea of what the current thinking is and how do we analyze what we have in our environment, what we call innovation, what we call fintech innovation. How do we analyze this? How can we sort of more critically think about these things so that they can help us when we make decisions, when we see these things, when we go to apply them, how can we get a better understanding of them, right? And I really, these are mostly to signpost you, right? Um, and so that when someone says, oh, this is a disruptive innovation, you can, if you get involved in the fintech area and you go to these fintech conferences, and there are in startup conferences in Hatch, and have you heard of Hatch? Have you heard of Hatch? So Hatch is in Sri Lanka. It's sort of a startup with a fintech, sort of a startup accelerator, right? Here we are, Hatch. right? So it's for or any startup, these new companies, they can come and they have space to come and uh,
Working space.
yeah, they have working space, they have a mentoring program. Now if you go, they have this incubation program where they can just start their business very small and see whether it works or not. Then they have these mentoring programs, um, right? So they have all these programs here now. That is hatches. If you go to these hatch sessions, if you join online nowadays, there will be a lot of startups that say, sorry, that's the family Skype messages that are popping up. You will see that the word disruptive innovation, fintech innovation, these words will come up, right? If you go to these, just even on YouTube, type, you know, innovative startups and go for their presentations, they will say that they're disruptive, they're disrupting the banks. You know, if you go, a lot of the fintechs, they will say fintechs are disrupting banks, right? Through disruptive innovation and things like that. So you will find this word disruptive a lot, right? And when you find this word, um, then you will understand why we are studying this, right? So the word disruptive, now when we say disruptive innovation, it means that something is uh, is disturbing a status quo, right? So this innovation is not just a innovation, it is disruptive innovation. That is the adjective. The description of that innovation is that it is disruptive. It is not radical or architectural or routine, it is disruptive, right? So what is it disrupting is the question, right? So so this Professor Clayton Christensen in 1995, he came up with this term, right? And now, if we take the word disruption just in the dictionary, let's type disruption meaning, right? Now, disturbance or problems which interrupt an event, activity, or process, right? A radical change to an existing industry or market due to technological innovation. Now, the dictionary is also saying disruption is radical change to an existing industry or market due to technological change. Now, the Oxford Dictionary is also trying to capture this disruptive innovation. But theoretically, disruptive innovation is not this radical change only, right? This is where we need to understand. Disruptive innovation is a very specific term. So, disruption describes a process whereby a smaller company with a fewer resources is able to successfully challenge established incumbent businesses. Now, most of the fintechs, most of the third-party fintechs, most of these guys who come to Hatch, all around the world, there are fintech incubators, accelerators, fintechs outside this. They are non-banks, right? A lot of them are non-banks. A lot of the fintechs happen at non-bank level, right? They are smaller companies and they come to disrupt. Sorry. They come to disrupt the uh, the incumbent businesses. Now that is why for this course, which is on fintech innovation, I have selected to discuss disruptive innovation, because for our course, of the 4 types of innovation, of these 4 types of innovation, this is the most relevant type of innovation for our course, because in our the companies, the types of innovation, they mostly call themselves disruptive innovation. So now we can understand what is disruptive innovation, right? So many researchers, writers, consultants use disruptive innovation to describe any situation. Now, this is not me who's saying this. This is in this main article that I have given you the link to, right? And I always give all the references, all the sources that I use, they are there. So you can also on your own go and study much further, right? I'm sharing all this information with you. So you are free to go and study as much as you, because this is a limited lecture hour session, which I'm covering a very wide scope, right? So I can't. We are not going into, if we want, we can have an entire course on innovation or on fintech or on payments, right? But we have decided to join this because under the current situation in the industry, it is important that you know both these areas because they are interconnected. But if you want further information, I have shared, and within those links also there is more links. So if you are interested in any area, you can go much further. And if you want any other information like where to find data or anything like that, you can ask me, right? So let's go to this video that explains. So just keep this in mind, right? So this is what I wanted to highlight to you. Many researchers, writers, consultants use disruptive innovation to describe any situation in which an industry is shaken up or previously sunk. But that is not what disruptive innovation is, right? That is not correct, right? Can you see and hear the video?
Can't see, madam.
Can't see.
How does a
Can you
small
see
young
it now?
company beat an industry giant on its own?
Not
Can you
yet.
see? Can't see.
Can't.
Okay. Can you see this screen now? With the video? Can you see the screen now? Dan, can you see the video screen now? Can't see. The apparent also can't see. How do we do this? Can you see the screen? Can you? Okay, now okay. Thanks. Okay, now where was that? Now I need to find it. Okay, here we are.
How does a small young company beat an industry giant on its own turf? Through what Harvard Business School professor Clayton Christensen calls disruptive innovation. It works like this. Big players focus on sustaining innovation, upgrading existing products and services to attract higher paying customers. But soon, they start to ignore all the regular customers who just want simple, low-cost alternatives. That's where the entrepreneurial company jumps in with that basic offering. The big guys stay focused on more profitable customers and begin to overserve, adding bells and whistles no one wants to pay for. Meanwhile, the disruptor improves its product to appeal to more people. By the time the incumbent notices, the disruptor has already started to take over the market. The classic example is the steel mini mills, which first produced low-quality rebar, then moved to sheet steel, stealing business from the large mills that had been dominant. More recent disruptors include car makers like Toyota and Hyundai, which launched with economy models, then added luxury features and brands. The only way for industry giants to fight back is by launching their own disruptive innovations. To succeed, they must treat the project as a separate unit with a different business model and growth expectations. Ask, what job do customers need to get done? Segment customers by job, not by product, market size, or demographics. And develop basic, low-cost ways to get the job done. That's how Procter & Gamble came up with Crest White Strips, a cheap, do-it-yourself alternative to an expensive dental service. Disruptive innovation creates new markets and reshapes existing ones. To achieve growth in a fast-changing world, you want to be a disruptor. Don't be disrupted.
Right. So I hope that was clear. Now, what did you get from that video? What message did you get from that video? Anyone? What message did you get from the video? So what that disruptive innovation is talking about is can you see the screen? Can you see the screen? Not sure if you can see the screen. Yes, okay. Right. This one. Right. So what disruptive innovation is talking about is when small companies come in and disrupt large incumbents. Now, in fintech, these large incumbents are the banks. Incumbent means the existing business, right? It's already there, it's already established. The new guys are the non-bank little ones who come in with technologies. They can access markets differently, right? Because they don't need to set up a big building and hire a lot of staff. No, directly through the mobile app, they can access large number of customers with very low overheads, right? They don't need the high overheads that the banks have to incur in order to facilitate customers. Now, banks are already there. They are already there. They are incumbents, right? The bank building is already built. The bank staff is already recruited. It's there. You can't just, oh, we have to become small and break the bank building. No, it's already, those are investments that have already been there. So then what is this difference? How do these small businesses disrupt? Now, according to Christensen, his basic model is that what he says is these small businesses target the areas that the large incumbent is ignoring, right? Incumbent, now number one says incumbent businesses innovate and develop products for their most demanding and profitable customers. Now think of your banks. Think of your banks, right? Think of, now you all are all bankers. Think of the products that you give your high-end customers. And think of the products you give your low-end customers, the customers with the small bank accounts, the small customers with the small salaries, the customers who are not salaried, the small businesses, right? Now think of them. What different products, what different benefits do you all give the different customers? Can you all share? Now, when a big customer comes to get a loan, right, a big customer with a big, not a big customer, even some middle-level executives, even like us government servants, right, who get a continuous paycheck, right? All the banks are coming after us to sell credit cards, right? Now I have stopped. I don't entertain because there are so many credit cards are coming behind us, offering all sorts of deals, fee waivers, discounts, cashbacks. But there is a group who can't get a credit card, right? They can't get a credit. They are the people who need the credit, but they can't get it. And you all, why don't you all give those people the credit cards? And why do you give us the credit cards?
Maybe their capacity is insufficient, or historically that lower income group repayment had not been great, reflects in the NPLs.
Exactly. So because of your business now, because your business is bigger, right? The bank's business is bigger, they can afford to ignore certain types of customers, right? They will because the risk is for them is greater, right? And the amount of work that they need to put in to service those smaller clients for small margins, right? For small investments, is more costly for them, right? With considering all your overheads, like sometimes the amount that you have to pay the officer who has to look into that is higher than the return, the income you get by servicing those customers, right? Because of the nature of your business. But there is a market that has been untouched. Now they want this credit, they need this credit, but the banks are not so keen to give them the credit. So then you have the new entrants. They meet these low ends at a reduced cost because they have much leaner business models, right? They will have a few staff. They might not even have an office building. They might be hiring something like Hatch, some office space. They just have a few laptops, right? Uh, they don't need to, they are all founder members. They might be taking very low salaries. So they can come up with low end products like crowdfunding, right? Peer to peer lending services. We learned in the last lecture, peer to peer, where you come up with a platform so that people who want to lend money and people who want to borrow money are connected. And the platform service provider is taking a small fee for connecting the two groups, right? And doing some background check and things like that. They will charge a small fee. But the surplus and the deficit groups are matching, and then they will the smaller customers will get the credit. Maybe there is some collateral, some arrangement will be there, right? So now the new entrant has now entered this credit market, right? Now the bank is not so keen. Their bank, the incumbents don't respond to new entrants, continuing to focus on their more profitable segments. Then what happens now when you are looking at this? Here now let's look at the graph, right? Now this is the product, right? The higher performance and the lower performance, and this is time, right? Now this is the high-end market, which is the most profitable, right? Now this is the low-end market. This is the least profitable. Now the new entrant, the fintech, has started around here, right? It is serving this low-end market, and slowly, it's improving its product performance, right? Now it's not only focusing on that low-end market, slowly it is adding new features, right? Now, new entrant is eventually moving up market by offering solutions that appeal the incumbents' mainstream customers as well, right? Now, a good example is Dialog Easy Money, right? Easy Cash. Now, Easy Cash originally was targeted for the bottom of the pyramid. People, domestic workers who want to send money to the village and things like that. But slowly now, we are able to pay utility bills. We are able to do so many other things with Easy Cash. Then we can top up from the bank account, right? We can top it up online. We can use it for online purchases, right? Now the bottom of the pyramid facility is still there. Still, the USSD code based payment transfer is that basic function is still there. But on top of it, they have now improved it. Now they have this QR code payments on top of the internet payments. Now they are building their base, right? And now recently they have this cash withdrawal machines because of this COVID issue and all of that. And also merchants, though they like to take the money from the people, they don't like to give money. Withdrawing money from the merchants is very difficult. So we gave permission for them to have cash withdrawal machines. So slowly, now they are expanding, and they are competing for mainstream bank customers as a payment alternative, right? And I wouldn't say they have disrupted the banking industry, but certainly they are moving upstream, right? They are moving to the mainstream customers, right? So then the incumbent is following its strategy by sustaining. They are sustaining their strategy and going up the high-end market, right? But eventually, the new entrants will disrupt. Once the new entrant has begun to attract the incumbent businesses' mainstream customers at a large scale in mass, disruption has occurred. Now, that is the disruption. They have disrupted the incumbents' customer base, which is the incumbents' business. Business at the end of the day is the income and the profit, right? Once the incumbents customers instead of taking the service from the incumbent goes to the new entrant due to cost and whatever efficiency, at that point the disruption has occurred, right? Nikangma, not just upsetting or disturbing with technological innovation, that is not disruptive innovation, right? When this process gets completed only, it becomes disruptive innovation. Otherwise, you can have so many apps, but if they are not going and upsetting the incumbent's business, taking the customers from the incumbent's business, it is not considered disruptive, right? You are merely treating an uncatered for market, right? And but once you keep going up and you're going into the other person's market segment, then you have started disrupting, right? So just merely serving the underserved market is not necessarily disruptive. It is innovative, of course, right? It is fintech, of course, but it is not disruptive, right? And where banks are concerned, there are two things to look at. Are we getting disrupted? The other side is, what are the customer segments? Who are the customer segments that we are ignoring, right? Who someone can gradually develop a competence to disrupt the banks, right? Is that clear? Any questions? No questions? Okay. Right. So disruptive innovations originate at the low end or what is called new market footholds, right? Now, low end footholds are where the incumbent is typically try to provide their services to the most demanding customers, right? And they keep improving their products and services and ignoring the less demanding customers. Like now this is M-Pesa, low end products. Most fintechs look at the retail customers, right? Most fintech innovation happens for retail level customers because, as we have discussed throughout this course, banks traditionally have targeted larger customers like corporate customers. Their initial digital infrastructure innovations, uh, digitalization programs were for the large customers because they had to make large infrastructure investments, and the corporate customers were the ones who were able to match that, right? So with their own infrastructure investment. So it was the large companies were the ones who were matching, right? For retail customers, it was like a community service where they said, okay, you can hold your money, we will take interest, we will give you small loans, you can come to the bank and take the money, right? If you want your money. Here you can write some checks if you like, right? So that's the way the retail customer was treated, very basic service provided like a community service. Even though retail small, but when you add up all the retail customers, you get a fair amount of uh, balance, so you can invest it, right? But mostly the target was the large end customers, and still that is so. Now certain banks, now Citi focuses solely on corporate clients now, right? They felt that it was not worthwhile to waste time on retail customers, right? Then they close the Citi retail customer accounts, right? And so these are the things that happens when you are a larger bank, right? Then the incumbents' offerings often overshoot the performance requirements of the latter, that is of the less demanding customers. The less demanding customers don't need so much, like they don't need so much credit, or they don't need so much cash back because it's not affordable. Now, even um, if you give large amounts of credits, and now what is it? Now I consider myself a less demanding customer, right? I'm in the middle. Now they are giving me all this what to convert into interest free and keep paying, and I don't take those, right? I don't necessarily need that, right? I can, if I have a much simpler system, it might be easier for me, right? Now, when all of this is there, the disruptor has a more focused way of providing to the low-end customers with a good enough product, right? Now, an example is the low-cost cars. Now, we had the Japanese cars, and then we have Marutis, and the Indian market. Now, the Indian market, it's a recent one, and we can all see this very well. More than the Japanese market, we can see it in the Indian market. Now, look at Maruti, the car when it started, right? It was a small car, right? We have all gone in Maruti. There's all small car, very basic gear change and all of that. But with time, now it has gone slightly up market, and the cars are more comfortable. They are serving. They have more high-end cars as well, right? Of course, they're still not high-end in the sense of European or even Japanese cars, but they are going up the market, right? Because it was a good enough product for the low-end customer, right? It was a good enough product for the low-end customer, and it was disrupting the second-hand Japanese car market, right? So in Sri Lanka, people would buy second-hand. They don't have enough money to buy brand new Japanese cars, so they will buy second-hand ones, small second-hand ones. But when the Marutis came about, they were able to buy a brand new car at a cheaper price than even a second-hand car. So now then Maruti, with time, they made improvements, and they have expanded, right? And so this is how the new entrants slowly they find a niche in the market that is underserved, and then they disrupt, right? Now, another, like the low-end photos, this is the other one is the new market. Disruptors create a new market where none existed, right? So simply, they find a way to turn non-consumers into consumers, right? So the example that they have given in the literature is that of the Xerox photocopying machine. Right now, we still have this photocopying machine, not this one, but all of us, we have large photocopiers in our offices, right? But this was for large companies who could afford these big ones. But then school libraries, smaller customers were priced out. And subsequently, they started making personal copiers. Right now, when I was making this lecture, I just went and just typed portable. I just did a random search, right? And these, there are so many copiers now. Now, no, you don't need to buy this bulky machine. Now, even the printer that I have at home, it has a built-in, I just bought the printer, but it has a photocopy machine in it, right? So that is how much it has changed. The large photocopy machine companies are still there, but these normal printers now all have photocopying capacity, right? So that is innovation. Now they have created, now us as consumers, we did not want to have a photocopy machine at home, right? We were not looking for a photocopy machine at home. But now when we buy a printer, we look whether there is the photocopying function, right? Because it is inbuilt. Already now this is the second printer that I'm having at home with the photocopy function. Now when I look for a printer, I look whether it has the scan and the photocopy function. It is taken for granted. It has become a part of the item. Now when we buy a phone, now we expect the phone to have a camera, right? We are not, very few of us go out unless we are professional photographers or interested in professional photography. We don't go and buy cameras on our own now. We are just depending on the phone camera. It's taken for granted. It is a market that wasn't existing. They have created a new market. right? So this is another place that disruptors come, right? In banking and payments, are there any areas like that we have noticed that that it wasn't there, but now you have created a non-existing market, a new market? Anyone? Any that you have seen any new markets that have emerged from any banking products that you all have seen, savings accounts, any type, that things that didn't exist that you all have created? Not as a small company, as the banks itself, are there any new things that you all have created? No?
Mobile apps.
Yeah, I suppose mobile apps is one. I was thinking more like, you know, this NSB, where they started this Iturumituru. Remember? Now, there were children's accounts, there were adults' accounts, but then suddenly I'm not sure whether this is a very good example, but I'm just thinking whether Iturumituru is one of those, a new market, right? Where they created accounts for teenagers. Now, until that time, teenagers were going on the children's accounts, right? Until 18, they could use their children's accounts. But Iturumituru gave, I think it was over 16. You had to be over 16 or something like that to become Iturumituru. And they gave this account for teenagers, and or was it over 18? I can't remember. And they gave a debit card as well, right?
Even HNB had HNB teen
Okay. And
account, and they were given the debit card where they can only view balance and all that.
So that it's a new market, right? That was not earlier identified, and it was very successful because the teenage market was not targeted until that time, and they gave special prices, and it was made very fashionable. I remember the Iturumituru, they had this denim pocket, and it was totally targeting a new market segment, and it drew in a lot of new people at a unexpected point in their lives. And people continued, they reached out to a new market segment, that because most of the time children's accounts, what happens is only the parents keep putting money, but with Iturumituru it made teenagers and the young people, they were youth accounts, and become more aware of financial services and using debit cards, and using their money and becoming more financially sort of aware and responsible. And I think that might, though it is not directly relevant to this new market foothold, because we are talking about small uh, uh, small firms, but I think conceptually it is a new market, right? I just wanted to show you all what a new market could be, because in banking it's difficult outside this bottom of the pyramid and all these peer-to-peer lending and these very fringe things. In banking itself, I wanted to show you all what a new market, identifying a new market within what we saw as a new market, right?
Madam, there was one product in HNP those days, they launched investment plan accounts. So that was not the generic savings product.
The Capital Plus or something, no?
No, investment plan where they gave a higher interest. There was a monthly commitment that the customer has to make every month. Thereby, uh, so the savings habit was created. I mean, those days people used to go and put money on a unknown person, sometimes way of seed to
Right.
informal ways. So this gave kind of a new opportunity to save within the banking system itself.
Investment product. So that's good. Now thing about Sri Lanka is we find that we though we have an informal sector, our formal sector also responds quite a bit to the niche markets. We see that as well. But having said that, things like seed to peer-to-peer financing, or that is now C2 is a peer-to-peer financing, right? It's a peer-to-peer credit lending. Sort of a crowdfunding model. So we find these now with technology. Instead of the person going to find 10 other people, you can just log into a platform and find those 10 other people, right? So that is how the innovation happens. So then so disruptive innovations are basically initially considered inferior by most of the incumbents customers. Now that is a good, now we don't rush to, now if you take easy cash or mcash, your main customers won't rush to take easy cash mcash, because for them it is not, they are not the target market, they are not interested in it, they have a better product with their banks, right? Uh, the typically customers are not willing to switch to the new offering merely because it is less expensive. Just because it is cheaper or easier or something like that, we are not going to just switch to that. Another side to it is now if you take non-bank finance companies, right? You will have your bank customers who don't invest in finance companies. There are some people like that. Even though they give a higher rate, right? They don't want to leave the bank because the service that they see from the bank is very different to the service that they see from the finance company, right? Instead, they will wait until the quality rises enough to satisfy them, right? Now if you take finance companies also, certain finance companies, they have with time evolved and they have built a reputation of trust. Then you will have mainstream customers going and putting their money there because they have gained a lot of trust and people see them as stable institutions, and their service matches what the incumbents main customers like, right? Once that happens, only they adopt the new product at the new price, right? Then they're like, oh, then why, this is very trustworthy, why am I spending money here, I can just buy it over there, right? Now if you take even places like sometimes now Satosa and all, initially people will, oh, the service is not good, whatever. But if Satosa, when you open a nice Satosa and all, you will see a lot of the customers who go to other places go in there, right? So that is how this incremental disruptive innovations can happen, right? Um, then why is it important that we understand disruptive innovation, right? Now you all have been learning this, right? Why do you need to learn this? Is it important? Do you all think it is important to learn this? Right now, I've been teaching this for now over 1 hour. What is your understanding of disruptive innovation? Do you see how it can threaten the banks? Now the same way, now let me see if I can find this for you. Mm. Here we are. This is from the University of Pennsylvania, right? Now you can, if you go, there are so many articles like this, right? Why fintech is disrupting traditional banking, right? And when you read to them, now they are saying this is how, in this is an example, right? Today, our T-Mobile account, that is a mobile service that we've launched, we give 4% interest. People are paying average $10 a month on a checking account. It's close to 112, 120 a year in just checking account fees, that is the current account fees. That's a national average. ATM fees are still going up. And people have insufficient access to ATMs, right? So this way, now T-Mobile is disrupting the banking sector, right? Now they are directly saying, okay, now you can have a T-Mobile account and you're getting 4% interest, right? So this is, now you will, there are many apps that are now asking for interest bearing accounts, doing the services of banks, right? And that's why banks are going and acquiring these fintechs, because they can't, instead of them trying to develop uh, these capabilities inside, they quickly go and they acquire fintechs that they think will either disrupt them or that they think will expand their capabilities to compete in the market, right? Because otherwise, slowly they can come to a point where the banks get disrupted. Now, abroad, things like peer-to-peer lending has already impacted banks. Right? Some banks feel it, right? So, this is why we need to understand disruptive innovation. Now, one thing about disruptive innovation is the term disruptive innovation is misleading when it is used to refer to a product or service at one fixed point, rather than to the evolution of that product or service over time. Right? So disruption doesn't happen today. Like, in the sense, it doesn't happen in that fixed moment. It happens through time. So sometimes what you saw before, and you will, in about 10, 15 years, sometimes 20 years, without the incumbent knowing, the incumbent may have lost its market. Right? That is the thing about this disruptive innovation. It is not immediately, like tomorrow the banks are not going to crash, right? today you might feel, oh, these guys are very small, they are in the periphery, they are just doing whatever, but they are having an impact. That's why a lot of your banks already have these digital innovation units. They have subsidiaries that are doing IT development and innovation, right? Because they are responding to, because they know that these guys have a ability of disrupting them, right? Now, examples is my mini computers and mainframes. Now, in the 60s, 70s, mainframes, most of your computer banks also have these mainframe systems. But mini computers, the small PCs and everything, they came about, and they have slowly mainframes out, right? Now, Netflix, if you all know what Netflix is, do you know what Netflix is? Netflix is an online streaming video, movies, everything you can stream it online. You pay monthly. And it started in 1997. It was not very well known, right? Slowly, with more people having internet, more people, not buying uh, computers and laptops also. Not now, the present laptop that I have don't have it doesn't have a DVD drive. I think many of you also might be having laptops like that. They don't have DVD. I have to plug in an external DVD reader if I want to watch a DVD on my laptop. uh, because why have they done that? Because now it is possible for us to watch everything online. It is not necessary for us to put the DVD and watch. But previous computers, the DVD drive was there. If previous ones, the mere floppy drive was there, right? Now none of the computers have it, right? Even the desktops we have don't have floppy drives, right? So therefore, we have the technologies change, and now because of all that, Netflix is with COVID and the lockdown, it has become one of the most profitable companies, right? And DVDs are hardly used, right? Um, and That's now, even if you go to DVD shop, if you just go to the CD shops like Torana and all of that, they are, those days they used to be full of people. Now there's hardly any business, right? Because there is YouTube and so many other ways of streaming music. This has happened over time. It doesn't happen like today or yesterday, things like that. It happens over time, right? Then the next point, disruptors often build business models that are very different from those of incumbents, right? Then that's another thing to spot. Now, when the iPhone is now the example that has been given is the iPhone, right? Now, it looked like the iPhone was an innovation for other mobile phones, right? iPhone is the first sort of proper smartphone that we had. But actually, it was an innovation, it didn't disrupt the mobile phone market, right? iPhone as a mobile phone was a sustaining innovation. It was an incremental one, right? Routine innovation, continuous development. There before the iPhone, Nokia had a phone with internet connection, and you could do all those things. What the iPhone did was it actually disrupted the laptop market, right? Now we know this now. Subsequent to the iPhone, other smartphones also followed the same model. Now there are a lot of things we are using the phone, right? Even to read documents and search the web, we don't switch on the computer. We just do it on the phone, right? Watching videos, all of that we are doing on the phone. The laptop is used for very specific things, like preparation of documents, or like this PowerPoint presentation, or sort of larger things. Most of the things that we actually used to use the laptop for, we are now using the mobile phone. So what the iPhone actually disrupted was not the other mobile phones, what people originally thought. No, it disrupted someone completely different, which was the laptop, right? So even if we take in the payments, is there examples of that? We said that's a good example, and I have actually pointed this example out when I was doing the section on payment instruments.
Now the debit cards are also being used for international transactions.
That
Like
is, yeah, that is one. And then, but more than that, a stronger example is QR codes.
yeah,
Where now you don't need the debit card, you don't need the check, you don't need the all the instrument, the card instruments, the physical instruments can all be replaced because all the physical instruments are interfaces to the bank account, right? That is, they are saying here, use this instrument to access the money in my bank account. That is what checks do. That is what uh, debit cards do. That is what credit cards do. And that is what the QR code and even internet transfers, right? SEF transfers. That is what it does as well. So all those instruments are getting disrupted. I mean, the intention was not to disrupt those instruments. It was just to facilitate faster payments and to make payments easier and add new efficiencies. But the effect is, especially checks are getting through real-time payments and QR code. These instruments are getting disrupted. They are getting replaced, and it's slowly happening as more and more people start using it. There is less need to have these physical instruments. Understood? Is that clear? How the business models are very different to those of the existing payment instruments, right? It's coming from a separate place, completely separate place. There is no special card issuing or anything like that. Customer doesn't need to be issued with a debit card or anything like that. Yes, there is a QR code, but there is no special issuing process. There is an onboarding process for the app, and that's it. There is no card renewals or having to take new checkbooks or anything like that. It's just there once you have onboarded. There is a disruption involved there. Then the next point. We have to understand that not all disruptive innovations succeed, right? Some don't. Now, if you take the 1990s, there were many disruptive innovations, like from the internet companies, right? But not all are successful, right? By calling every business success, disruption, companies that rise to the top in different ways will be seen as sources of insight into a common strategy for succeeding, right? This creates a danger. Managers may mix and match behaviors that are likely inconsistent with one another and thus unlikely to yield the hoped for result. Now, that is the other thing that is important to remember. Just because something looks disruptive, it doesn't necessarily mean it will succeed. And just because some company is doing it is successful as a disruption doesn't mean that you can copy it and it's going to work. Because strategies have to be combined, right? And sometimes what happens, we see this also even in banks where one company, one bank is doing something and it is looking, this one is very successful, I'm also going to do the same thing, and it doesn't work, right? They do things, this bank is doing this bank is doing that, I will do this, that, and everything. Then finally what they do is a flop. If you look at your banks, you will also see such, there may be such examples that you can cite from, right? And also some people feel, oh, we have to be the first to disrupt, otherwise we will get disrupted. That is also not necessarily the case, right? Incumbents shouldn't overreact. Right? They should remember they still have profitable businesses. So you already have your incumbent customers. You shouldn't try to suddenly run to low-end customers, forgetting your high-end customers. No, they should strengthen the relationship with the core customers by investing in and sustaining these innovations, right? So you have to keep focusing on the high-end customers, but slowly, if you can afford to, make, like, some companies, they have these digital low-end customer products and all those things. I remember now, if you take this Bowers Pharmaceuticals, they used to only go for high-end Swiss pharmaceuticals, right? These Novartis and all these high Swiss brands, right? And then they realized with India and Bangladesh and all those countries manufacturing generic pharmaceuticals, that their market share was getting disturbed by this, right? So then they started a separate unit for low-end pharmaceuticals. So while the high-end pharmaceuticals were continuing, they had a separate unit to focus on the generic products. So same way in your banks also you will see this, that there are those who treat the corporate customers, and then there are separate group who serve the low end retail customers, right? So this is how you have to have a mixed sort of a clear strategy when you're going about through disruption. Right. Then, sorry, this disruption is not straightforward, right? It should be not straightforward. Incumbents must not be afraid of new entrants, right? But pay attention. You must pay attention to the changes that are taking place, because before you know it, they might, because with the internet, it's easy to reach customers, and customers are now more aware that there are alternatives, right? The customer loyalty is different now. It's not the same. So the incumbents must always be looking at what is going on. They can learn from the environment, they can adapt, they can acquire, they can take many steps, but they must pay attention, because it is very possible nowadays with the internet, the technologies. It is very, very possible for disruptive innovation. And not all new entrants are successful. In the initial study of Christensen, only about 6% were successful, right? But when they actually disrupted, they properly disrupted those few companies, right? And sometimes knowingly or unknowingly, the incumbent may be going into the low end markets through its automatic strategies, right? So you have to be aware of what's going on. These are not fixed, like it's either this or that. So you have to be constantly aware of this, right? And what you have to keep watching is the disruptive innovation. The understanding of it is growing. So if you read more of this, you will see that there are nuances, there are changes, there are mixes, there are matches. But these are sort of the basic concepts that you can go by. So we've discussed several of the examples in Sri Lanka. Are there any questions that you would like to share with us, or ask, or any observations before we end the lecture? Right. So there's another, if you are more interested in disruptive innovation, you can go to this Christensen Institute as well. They also have a lot of stuff on it. Yeah, so I will stop at this. Just keep this in mind. We will discuss these points. I will probably in the assessment also I will touch on this because it's important that you all know, right, and you all can explain these things, right? Um, um, yeah, if there are any questions, you can ask. Are there any questions anyone would like to ask? Now, are you in your banks? What is the are there discussions about digital innovation? How is the general discussion going on at your banks? Is there a general sort of is it limited to a group that is called digital innovation group or something like that, or is it across the bank? Are you all invited to come up with new ideas and things like that? How does it happen?
We have a separate digital banking team.
Mm-hmm.
Other than that, we have a scheme called Search, where we can give our suggestions.
Mm-hmm.
Thereby, they will take whatever the good ones
Mm-hmm.
and take to the development level.
Mm-hmm. Right. Any others? So that is a good way because most of the operational staff, right, and people who are involved in day-to-day activities, that you all can see places that changes can be made, efficiencies can be gained, issues in the system that need changing. You all can see it, I think, much more than the digital banking teams. The actual processes, especially for routine innovation, for architectural innovation, you all can see those points that can be changed, and that having that access point is very important, I think, for all organizations. And having a good line of communication is vital for innovation within any organization. So it's very good to have that, and to have lines of communication. And of course, innovation shouldn't only be for digital banking. That's the other side. There are a lot of process innovations that can happen, business model innovations that can happen without major technological changes. I think another mistake that a lot of places make is they often connect innovation with digital only. But innovation doesn't necessarily, it's like the cars, right? So cars, constantly changing. It's not digital per se, right? The car itself is changing. So innovation can happen anywhere, like the biscuit, but the example of the biscuit, the Munchie biscuit, the taste is changing. So that is not a digital. Of course, they might be using computers, but the card, the biscuit itself is not a digital thing, right? So therefore, there will be changes. There can be changes in the processes, in the forms, in business models. So many things that their innovation can take place that can increase efficiency, lower costs, and also expand the markets and services to customers. So I think constantly it's very important as bankers, because especially for banks, and this is really why fintech came up, because banks forgot to innovate, right? And it's a global thing. Banks were so consumed in continuously providing the same services, and banks became quite complacent and comfortable with the fact that regulatory and in most forms that the banks are the only place for people to come and safely keep their money, right? And then it was the place where big corporates came to borrow money. So when that was the case, there was no incentive for banks to innovate. So the culture of innovation had left banking, right? And but even though the culture of innovation had left banking, there was a growing number of low-end retail customers who were underserved, and that is how really fintech, together with the rise in technology, what we've discussed from the beginning, right? Now we are connecting. Now slowly you will notice we are connecting everything now we have learned in the first few lessons. We are now connecting each and every one to this theoretical point that we had discussed today. So that lack of attention given to the customers is what has culminated in these disruptive innovations taking place world over. Like more in other countries, lot in. I had a wait. I had let me see. I had this. I think it was in this. Right? Was it here? I can't remember. Let me see whether it's in this document. No. I had a. Let me see whether I had a. I'll probably share with you in the next because it's relevant to another topic. Let me see if that is here. No. So what we see is that the disruption has happened a lot more in Western countries, in China, right? In African countries, by fintech, because they had a much larger underserved population than in Sri Lanka. In Sri Lanka, the financial inclusion is relatively not so low, but financial literacy is low. So a lot of people don't use banking services, and that's a very different problem that we need to solve. But nevertheless, the disruption can still happen with payments, with alternate lending systems. Now we are having the problem. There was some article there with the issues in the economy. People are putting a lot of money into things like cryptocurrencies, right? There's a very high risk involved there. So, so these people are always trying to find ways to make money, save money, right? So in that environment, it's very important that banks are continuously keeping in touch with what's going on in the environment. If there are no other questions, we'll end it there. I'll just resend this. Presentations, because I changed a word in it, and you can take the new presentation. I'll send it to Carnegie and he will circulate it. So thank you very much. And next Sunday, let's meet at the same time.